Greetings, Dr. Scott here at your service. Let's talk about the accounting cycle and making entries that ultimately will lead to financial statements. I'll go ahead and share the screen, and we're going to take a look at what the accounting cycle looks like. It's a multi-step process. It starts with analyzing transactions. You get a bill in the mail. What do you do with it? Well, you got to enter it in the books. So how do we enter it? We first analyze. Number two, we prepare and post the adjustments. Once we get those adjustments going and in the books and recorded, we go ahead and prepare financial statements. And the financial statements will fall right out of the books. It's called the trial balance that we're looking at. All the balance sheet stuff will come out. All the income statement stuff will come out. We'll see that in a few moments. And then we close the books. We close out what are called the temporary accounts, the ones that go to zero, like on the income statement. Our sales goes to zero at the end of the year. We start afresh. Our rent expense goes to zero at the end of the year. But our cash doesn't go to zero. Our accounts payable doesn't go to zero. Too bad, too. Our receivables hopefully don't go to zero unless we get paid. So all these things are done, analyzed, and then closed out, and we start from scratch. Let's take a look at a bigger picture of what this accounting cycle looks like. So I'm going to expand this a little bit. And this is a 9-step. It's actually a little more clear, hopefully, to understand. We start by, again, analyzing the transactions. That was a step one in the previous slide as well. And then we do what's called journalizing. Every time we have one number, we put it in two places. So if we get investment from $10,000, we've done this on the board in our day together. $10,000 came in equity, $10,000 came in cash. Everything we're doing is double entry, at least, sometimes quadruple entry. We'll talk more about that as well. So we record at least twice what we call journalizing. And journalizing is in a chronological order. As the transactions happen, they go. Then we post into these things called T accounts. Cash is one T account. Common stock is a T account. Accounts receivable is a T account. Sales revenue, service revenue, rent expense, they're all individual T accounts. And that's where all the transactions get posted to. There's a posting process. Then we prepare what's called an unadjusted trial balance. We list all the potential accounts, all the balance sheet accounts. We might have 5 cash accounts. We might have 3 inventory accounts. We might have multiple notes receivable. You go down to accounts payable, notes payable, unearned revenues. All those accounts get listed on what's called the trial balance. We then go ahead and make adjusting entries. Those are entries that, and that's going to be in the next video, but those are entries that we talk about having. Let's see, at the end of the month, we're going to adjust some things. We're going to make our prepaid expenses actual expenses, our unearned revenue actual revenue, our wages payable and wage expense, make adjustments accordingly. We'll talk about the 2 rules that go with that when we get to our adjusting journal entries. But they get adjusted to the T accounts just like all the other stuff. So now you start seeing this trial balance not only has the unadjusted columns, left and a right column, it has adjustments in a left and right column, and then we have an adjusted trial balance that goes with that. And that's where the transactions go. From there, we go ahead and we take care of preparing financial statements. We can literally draw a line. We have all our cash accounts, receivables, our assets, followed by liabilities, followed by equity. On a trial balance, we draw a line. Then we get all our revenue accounts and our expense accounts, and those go onto the income statement, and we prepare the financial statements. Then we zero out our income statement accounts. Our temporary accounts go to zero. Our permanent accounts maintain, things that closed out to retain earnings. And we have what's called a post-closing trial balance. And then we start again. So what are some of the other terms that go with this? So let's take a look at something called the financial statement effects template. And the template is just a nice way of line by line showing transactions at the bottom. We'll see that in the next slide or two. What we have is the analysis of every transaction. And it's going to go, maybe it goes to cash, maybe it goes to receivables. Somebody paid their bill. Maybe it goes to revenue and goes to receivables. Somebody owes us money. Maybe it went to revenue and they paid us in cash. Again, doubling up. Our double entry accounting says every transaction, every number goes in at least 2 places, and we stay in balance. That accounting equation that we've been learning about, assets equal liability plus equity, always stays in balance. So the financial statement effect template is a nice way of laying things out and seeing things. And then we are able to capture the transactions in all four financial statements. Facilitates analysis, interpretation, and what if scenarios. The whole reason to do this is, all right, we got a historical perspective, but what else can we do? Let's make some decisions. Then we have something called T accounts and something called journal entries. The T accounts increases or decreases and keeps a running total. So let's take a look at a T account. I'm going to go in, I'm going to do a new share. We're going to go over to the whiteboard, and we're going to see how the T accounts kick in gear. So let's say we have a T account. I'm going to draw a little T account here, and I'll draw a couple. Okay. And I'm going to put some text in here, and this one's going to be our cash account. This is going to be our sales revenue account. So what happens? Customer pays us $5,000. We get $5,000 there. We get $5,000 there. Okay. And then another customer buys some stuff, but they're not paying us on cash. They pay us as a receivable. Let me go ahead. Mainly, they are at the top. So if we look at that, we say, okay, I got another customer that spent $10,000 with us. And actually, I don't know what happened to my 5,000 there, but make sure I put it there. So I get a receivable of 10,000. And then I get sales revenue 10,000. So if I total these T accounts, I so far have a total of $15,000 in sales. I have a total of $5,000 in cash. And I have a total of $10,000 in receivables. So what happens when we get paid? That's a good thing to do. Not a lot of customers will pay us, but let's say we get paid 8,000 of this stuff. So I'm going to just erase the totals here because the cash is going to change, the receivable is going to change. But let's say I get $8,000 in cash. $8,000 is paid to us, and my receivable is adjusted by 8,000 because we're never going to see that money again. You'll notice that we're not getting any more sales revenue when they pay us. We're on the accrual basis of accounting. That's what GAAP dictates. Generally accepted accounting principles doesn't really care about the cash when it's received to recognize as revenue. It does care about getting the cash to run the business, but the actual receipt of cash is not the significant factor determines whether we're recording revenues or not. So we recorded the revenues already, 15. We got paid 10 out of the 8. So what do we now have? We have a total of $13,000 in cash. We have a net of $2,000 in accounts receivable, and we still have $15,000 on our sales revenue. And if you look on the balance sheet, and remember our formula of assets equals liabilities plus equity, we're still in the same game where we have our assets when we got paid. Let's see, originally we had $15,000 in assets and $15,000 in equity in the form of retained earnings. When we got paid, we still had $15,000 in assets. We had $8,000 in cash asset going up, $8,000 in cash asset going down. Okay, so we had still the 13 plus 2 is 15 in assets and still have 15 in equity, the net effect on all this. So that's how the T accounts play out. If we go take a look and say, all right, interesting enough, let's clear the screen. We're going to go back to our PowerPoint and we'll look at the actual journal entries that go with that. Our journal entries that we made, that sales of 10,000 and cash of 10,000, that was the form of a journal entry. 10,000 went in cash, 10,000 went in sales. Or I'm sorry, 5,000. And then we did 10,000 sales and went in receivables. That was our other journal entry. And then we had another journal entry. We got paid 8,000. 8,000 in cash, 8,000 off receivables. So journal entries are recorded and ultimately posted over to the T accounts. Well, let's look at the FSET. These are assets, our liabilities, our equity, and they capture the transaction. We have cash assets, non-cash assets. Nice way to break it down. Cash assets is cash. Non-cash is receivables. Non-cash is any type of other equipment, any type of inventory, non-cash. We got liabilities, contributed capital, and earned capital. Contributed, that's when the investors write a check. Put 10,000 into the business, put 5,000. We sell stock. That's cool. Earned capital is from our sales, our revenues less expenses from our operations, and that ends up in retained earnings. So, and then we have our statements that fall out of that. And then we have our T accounts. We have increases and decreases. Cash sometimes goes up, sometimes goes down. That's an asset. Accounts payable sometimes goes up, sometimes goes down. Our equity account sometimes goes up, sometimes goes down. We actually can issue stock and we can buy the stock back. It's called treasury stock. We'll see more about that later on. Okay. So the T account captures all these transactions that go with that. And that gives you the big picture. And the assets have a normal left balance that increases. And otherwise, we get a decrease when we have a reduction like in cash. As opposed to liabilities, that's a right balance. Accounts payable, common stock, notes payable, mortgages payable will increase. But if we pay off our accounts payable, we'll decrease our accounts payable on the left and we'll decrease our assets on the right, or decrease cash. We're going to write the check. That's how it flows. And then we look at the journal entries. And these journal entries are pretty powerful stuff. They're capturing the effects of the transaction. We're looking, and don't worry about the debits and credits. I'm not going to be asking details on debits and credits. But the only thing that debit means is left and credit means right. That's the definition. When a bank credits your account and debits your account, that confuses everybody. You got a credit card or a debit card. We're not going to worry about that here. But we are going to worry about left and right. And the T accounts are the pictures that we're going to see. And we just know that assets on the left are going to go up. Expenses on the left are going to go up. On liabilities, equity, and revenue, on the right, they're going up. And on the left, they're going down. So that's the big picture on how that fits together. The last item we'll talk about is effective transactions. And this is that worksheet, that template we talked about. And this is just an example. Every time you have a transaction, it goes into at least two places. And you can see here, common stock, 45,434 million. I guess that's $4.3 billion. Cash asset up, contributed capital, that's contributed by stockholders, investment is up. Then we bought inventory on account. On account, okay, that's a payable. That's a trade payable. Not accounts receivable. When we owe us money, it's a payable. So our accounts payable jumped up and so did our inventory. Okay. Our T account would have accounts payable on the right going up and our inventory on the left going up. And then we sell inventories. And now we have not double entry accounting, but quadruple entry accounting. Not twice as much fun, but 4 times as much fun. So what happened? We actually sell inventory. So the inventory goes down, cost of goods sold gets reflected. That's at wholesale, that's at our cost. But then we have a retail price. We generate sales revenue and either cash or receivable comes in the door. That's at our retail price. So those are the things that are happening when we sell something and we own some inventory. Okay. And then we have somebody paid their bills. Okay, so we got a bunch of cash and we reduced receivables as that goes. So those are the flow that we want to be, that we're concerned with, and the template. And it's nice to have a line underneath the counts going across the top. Now you can break that down further. You can have cash as one, then you can have your receivable separate from inventory, separate from notes receivable, separate from fixed assets. On the FSET, it's all combined in all non-cash ends. Liabilities combined, and we'll separate between current and non-current as we go. Contributed capital, earned capital is a nice way to break it down. And then the income statement, we have revenues and expenses, and ultimately yielding our net income to go with that. And that's the big picture. Hope this is helpful. I look forward to our next video together. Thank you for your time.